Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in 30 minutes. Let's get to the stories we're following in the BNN Bloomberg newsroom. Donald Trump says the U.S. will postpone strikes against Iran's energy infrastructure for 5 days after productive conversations with the country. The American president suggests the U.S. and Iran could jointly control the Strait of Hormuz, which he says could be opened very soon if negotiations are successful. The head of the International Energy Agency warns the global economy faces a major threat because of the conflict. He says the situation is severe and no country will be immune to the effects, and adds a crisis in the Middle East has had a worse impact on oil than the two oil shocks of the 1970s combined, and a worse effect on gas than the Russia-Ukraine war. 2 Air Canada pilots are dead after an Air Canada Express plane collided with a fire truck shortly after landing at New York's LaGuardia Airport. The pilots died on impact. There were 76 people on board, 41 taken to hospital, many in serious condition. The cause of that crash under investigation. The province of Ontario will take ownership of city-owned lands at Toronto's Billy Bishop Airport. The Premier, Doug Ford, says the land will be declared a special economic zone, which will allow it to override environmental and other regulations. Ford says the runway will also be expanded over the next few years to allow more jets. Ontario introduced special economic zones last year to help unlock the province's economic potential. Here's where we are on the TSX right now. 613-point gain on the day, up almost 2%, now that there is a pause in the conflict in the Middle East. South of the border, it is the same. The S&P up 92 points, or 1.4%. The Dow Jones 1.6% up. That's a 736-point move. And the Nasdaq up about 1.7% today. Gold resumed its slide, but paired some losses on hopes of de-escalating in the war, or a little bit more de-escalation. My next guest believes gold is overbought. For more on movers, let's go to Jeff Barrett. He's general partner at Barrett Capital Holdings. Thanks for joining us today.
Thanks, Morella.
What do you think is making gold continue to decline, and where do you see it settling?
Yeah. Look, gold fundamental bid has come from this fear that U.S. sovereign bonds are in a bit of a tough spot and may be overvalued. And so what a lot of central banks have done is they've gone and put what they had typically put into treasury bonds, particularly the Chinese central bank, and they bought gold. And, I worked over in Hong Kong doing IPOs for a couple of years, and what struck me there was how oversubscribed IPOs could be hundreds of times, whereas a U.S. IPO, a good one, maybe 7 or something like that. And so it's a very herd mentality that exists over there, and I could see, as China's, the government through the central bank is buying bonds, you could see people, of which there's 1 billion of them, buying it as well. And so it's moved it up. And so historically, gold had traded inversely to U.S. 10-year real interest rate. And that relationship existed until a couple of years ago. And it completely broke down. And so
what triggered that?
Yeah, I believe it was the central bank buying and then, Chinese speculators jumping on it as well. And so I think what we've seen is they can really move markets, the Chinese, but it also ends badly typically. And so that's where I ultimately think what gold will do. Gold's supposed to be an inflation hedge. It's supposed to reflect real interest rates. Clearly that inflation's been coming down, and so gold shouldn't be escalating in that environment. And so it seems like a temporary thing. And look, if the U.S. can fix its fiscal situation a little bit, and that's asking a lot, but I think it will, then there will be renewed comfort in the U.S. 10-year.
I like the fact that you said if they could fix it a little bit, because it's a large ask for them to fix that.
I think the numerator debt doesn't necessarily get fixed, but what does get fixed is the GDP, because you're coming out of an economically depressed environment where you're going to see inflation and things like earnings really, and so the denominator increases, and then the debt to GDP falls to better levels.
Okay. Let's talk a little bit about what has been moving the market for the past 3 weeks, which is the conflict in Iran. And do you see that as something that will continue to stoke the volatility we're seeing?
Certainly. Look, it's been a hard few weeks. Markets looked oversold on Friday. I think we can all say there's a bit of a rally back. Look, the U.S. economy has three things going for it that are weaknesses. One is if oil prices shoot up, it hurts the consumer, particularly the low-end consumer. The second thing is interest rates. You know, everybody's got a home, so new home buyers, particularly this big young generation. You know, lower rates are going to help them buy homes. And right now it's hard for affordability. And so you can't have interest rates go up. And then the third thing I would say is what's driving consumption in the U.S. is this wealth effect. People have appreciated a lot in their 401ks. There's an older generation that has a lot of those assets. And that's all been under fire in the last 3 weeks. You've had oil shoot up from 60 to 100. You've had interest rates, the 10-year go from 2.9 to 3.3, and then you've had the market off. S&P's off 5% year to date as of Friday. The Nasdaq's more, but individual stocks are down a lot more. And so Trump has to do something. He knows that that has the potential to create economic problems. And so I think by the end of the month, he kind of needs to solve this before people get their brokerage statements.
I was wondering what the deadline would be for that, right? When does that pressure turn out?
I think people look at their statements monthly, and I think that's what impacts it. But he can't let this go on. Iran knows that, and that's why they're creating a lot of noise in the Strait of Hormuz. And so there seems pressure to do a deal. Do we know? Look, with a lot of uncertainty on who's saying what in Iran and is it legitimate? And
who's acting for Iran?
Exactly.
Yes.
So we don't really know what's coming out of there in the disarray. We'll never get clarity on that. But what it looks like is a similar model to Venezuela, which was what people had always hoped, which is you have regime change and the economy, the government works with the U.S. That's
sure,
the hope.
but that would have been a naive way to go into Iran's conflict, right?
Yeah,
Iran and Venezuela.
Do I think it was well thought out? No.
Okay. Let's talk a little. I do want to get a couple of stocks because Aritzia is a stock, a Canadian retailer that seems to be doing well. I'm wondering what you think is driving that, considering where we are and consumer confidence isn't necessarily high right now.
Yeah, look, Aritzia is a great little business. I have a daughter who's 12 who shops there a lot. I think they've really been on the fashion wave of what teens want.
The younger generation.
Yeah, and so it was well created through private equity, and they very thoughtful. They have as many stores in the U.S. as they do in Canada, and I think we all know that market's 10 times bigger. And so there's real potential for them to grow organically, and those were the same trends that allowed companies like Lululemon to grow. And so there's real upside for a number of years in that business. But look, if the consumer's not doing well in the U.S., retail's going to get whacked, and that stock in particular can get hurt because people won't be consuming as much. And so those are the uncertainties that are driving, you've seen oil price go up, interest rates go up. It's driving fear that the consumers are going to give in, the wealth effect's gone. And today the market's thinking differently about that because they think this is a short conflict, it's going to get resolved. And so the market was bid today, but it's tepid. People aren't totally sure. They're not sure if Trump's telling them the truth, and they're not sure what they're hearing out of Iran is true, and so it's uncertain.
Let's talk about your stock pick, which is Honeywell, which is sort of mid-spin-off. So I'm wondering, where are you liking it? Are you liking the part that's already spun off? Are you liking what's to come?
Yeah, look, my background is a special situations trader at Morgan Stanley in New York. I did that for 5 years. And so what I learned is how successful spin-offs can be. So let's go into that. You had GE's breakup. It was enormously successful for investors. And you had Kellogg's breakup. Also, both businesses were acquired, enormously successful. But there's a whole case history of successful spin-offs. And why is that? Well, it allocates capital better. It puts those companies relative to their proper valuation parameters, incentivizes management. It gives dedicated analyst coverage for certain sectors. And Honeywell's sort of caught in all of that. Honeywell's this bond-like business that gets valued at about a 5.5 free cash flow yield for this year. And a stable business that's impregnable. It has so much aftermarket revenue that it's really hard to put
to
a chink,
get up to them, yes.
Yeah, to put a chink in their armor. And it's a great business. 150 billion market cap. It's not small, but it's not everyone's first pick in the sector because it's in a bunch of businesses. And so you could go and buy GE or Howmet instead of buying Honeywell in aerospace, or you could go and buy Emerson or another automation company instead of Honeywell. And so it's kind of lost in that, and its valuation reflects that. It trades at about 18 times EBITDA for the current year. Aerospace, the GEs, Howmets of the world, Heikos of the world, they're 30 or 25 times EBITDA. And the best businesses in automation are trading well in the 20 times EBITDA. And so Honeywell's sitting there at 18. If it splits, it has return on invested capital and margins that are comparable to the best companies in both those sectors, and growth and financial profile. And so I think it will ultimately trade up to those values. So
I was going to say, where are you putting a target price on it?
Yeah, look, I think it's a double, and I think it could be a double in the next year.
Interesting.
Yeah, and so what else could happen strategically? It's interesting they're spinning aero and not automation. And so what is that? So in the U.S., there's a tax rule that says if something's spun off and it exists for 2 years, the capital gain on that business is not attributable back to the parent. And so it saves companies a lot of tax as opposed to just selling a business. And so if you don't spin a business, automation in this case, it means you're okay to sell that right away. And so I could see automation looks like a sector that could consolidate. So I could see the automation business get consolidated. And I think aerospace could trade up. And there's a lot of tailwinds behind commercial aerospace. We've just back to flight hours being what they were pre-COVID, just back. It's taken a long while. That could grow. And Boeing's production is like 600 planes a year now. It topped out at 800 pre-COVID. So there's real upside as Boeing fixes itself in terms of more Honeywell's products being attributed. And then the other tailwind on automation, even if it doesn't get acquired, is it's geared towards housing starts. And I think they've been tepid. A lower interest rate environment, more housing construction could really help it. And it feeds, all its products feed into housing construction in the U.S. And so I think that there's real tailwinds behind the business, potential for some M&A around it, spin-off that's generally created value, improved valuation. So it's my pick for the year. And I think it's a good enough company you can get in and out, and you don't have to worry about liquidity.
And down a little bit in the last while if you want to pick it up. All right, got to leave it there. Jeff, thanks for coming in. Jeff Barrett, General Partner, Barrett Capital Holdings. Up next, oil falling today again after Donald Trump hit pause on strikes and signaled progress in Iran. More in a moment.
We'll see how that goes. And if it goes well, we're going to end up with settling this. Otherwise, we'll just keep bombing our little hearts out.
Yeah, the U.S. president pausing strikes on Iranian power plants and other energy infrastructure for 5 days. Trump says it's because there has been progress with Iran talking about resolving the war. Let's go to Andrew Peak. He's director at the Atlantic Council's Scowcroft Center, former senior official in both Trump administrations. Thanks for joining us today.
Thank you. It's great to be here.
So is it clear who Washington would engage with in Iran at this point?
Yeah, so it's always a challenge finding a credible Iranian interlocutor. It was a challenge when the supreme leader was alive. It's a challenge, especially now that Khamenei is dead. You know, for a long time, the foreign ministry officials we used to talk to about the nuclear deal, the nuclear file, we call it, had no actual jurisdiction over the other key things that concerned us, the proxies and the missiles and so forth, as well as the civil right, you know, the human rights of Iranians protesting on the street. Now that Khamenei is dead, I'm not surprised that we're starting to go through a little bit of an iterative process to find an official who might be able to have some traction on rolling down the war in a way that works for us if we'd like it.
Okay, that being said, if it's not clear who that discussion is happening with, do you feel confident in a process that's beginning right now, according to the U.S. president?
Well, again, it's going to be iterative, and the fellow that's been reported as the interlocutor, Mohammed Ghalibaf, is a reasonable person to go talk to. You know, he's of the conservative movement. He threw his kind of political weight behind the hardline former leader Raisi. You know, he cut his teeth in the Iran-Iraq war, which is really the foundational experience for most of Iran's security elite. I mean, it's not going to be, we don't have perfect insight into Iranian politics, and we especially don't have perfect insight into the Iranian government's decision-making structure. But when you look down at the boxes of who a credible interlocutor could be, Ghalibaf does seem to check a lot of the key experience nodes.
There are reports other Gulf nations are telling Washington about the danger of hitting Iranian energy targets. What would you see as that danger?
Well, of course, that the careful facade of stability that all these states have built up, they're essentially just like European, just like Western developed nations, but in the Middle East, in a highly volatile region, would start to fall apart, right? So not only would you have the immediate degradation of the quality of life, but in places like Dubai, that doesn't have any oil, it's basically a trading emporium that for their mantle of impregnability, that the life they're offering expats and others would be forever shattered. So I think they're going to be, I think one of the diplomatic wins so far has been that the Gulf states have basically swung around to the U.S.-Israeli side on this, have taken, in some cases, a very hard line in their statements against Iran. But I would not be surprised at all if, since this is their way of life, their basic argument for their countries, that behind the scenes they'll be pushing very hard for de-escalation.
Okay, so what would it take, in your mind, to actually get the Strait of Hormuz reopened? Because there's been a discussion as to whether Iran would actually help with that or allow that to happen if these talks go well. Do you think that's a possibility?
So I think a couple of things. One is, most importantly, keeping the Strait of Hormuz closed is ultimately a declining asset for the Iranians. U.S. airstrikes are going to take a toll on their ability to project power. The start of the war basically removed the political cost for the Iranians to try to close the Strait of Hormuz. In a way, Iran always controls the Strait of Hormuz just because of its geography. It always can train 1,000 missiles on the ships going through, and presumably can always tell them it wants X or it won't let anyone go. In peacetime, the difference is that if they did launch a missile, they'd suffer significant political consequences. However, if Trump were to say tomorrow, I'm winding down operations, we've sufficiently degraded the Iranian threat, which I think is true. We have significantly degraded the Iranian threat. Even though Iran might not agree to an on-paper deal opening the Strait of Hormuz, there would be a fait accompli started to build up where the political cost of inflicting military power on ships passing the strait would increase, i.e., it would get tougher and tougher for Iran to say, okay, we're just going to free fire merchant ships going through. So I do think it's a declining asset, and I think that's ultimately the best argument for why the Iranians are going to settle.
Andrew Peak, got to leave it there, sir. Appreciate you joining us on this. Thanks for your time.
Thanks so much.
Straight ahead, an Air Canada plane you may have heard collided today with a fire truck in New York at LaGuardia's airport. We'll get you more details in just a moment. New York's LaGuardia has now reopened after an Air Canada Express plane with 76 people on board collided with a fire truck on the ground shortly after landing on Sunday. The pilots on the plane were killed. We got more on this from Bloomberg's aviation and transport reporter, Danny Lee.
Let me just walk you a little bit of what happened. So on Sunday night, late Sunday night, a fire truck was being given the authorization to go across the runway at New York's LaGuardia Airport, but it at the same time met an Air Canada Express regional jet operated by Jazz Aviation, and the plane collided with the with the aircraft, which had tragic consequences. We now know that at least the two pilots operating the aircraft, have tragically died. We don't yet have a handle on just how many passengers on board were injured. So that's 72 passengers on board and 4 crew operating the plane. But yeah, this is a tragic accident. And at a time when US aviation is under such great strain, and particularly on Sunday night, where there were air traffic control were dealing with a couple of emergencies during the night. So this had a cascading level of consequences. And what we see is yet another tragic accident.
What were do we know what the other emergencies were that they were dealing with? I mean, it's incredible, the idea that there was already 2 going on.
Yeah, well, basically, the other emergency, it all really revolved around another aircraft, which you could hear on air traffic control, that air traffic controllers were responding to. And actually, in fact, it's potentially why this fire truck was responding to another emergency. But of course, when you look at some of the horrific images and video that has been circulating on social media, such as the damage to the front of the cockpit, which has basically disintegrated, and the first couple of windows as a result, where the galley would be, and obviously at least one of the cabin crew. So you could see the kind of forceful impact that this aircraft took late on Sunday night, especially during a time there was some bad weather around.
All right, and now LaGuardia, a busy airport. What's the impact on just the operations and beyond?
Yeah, LaGuardia being one of not just New York's, but one of the country's busiest airport for domestic travel, it has at least been closed up until 2 p.m. Eastern. So that it actually involves around 500 flights so far on Monday being disrupted, cancelled in the main. But yeah, at a time when the U.S. aviation system is under strain, particularly around funding for airport security staff, the huge queues we have seen, and then the broader emphasis from officials to try and modernize the aviation system, the infrastructure, and to make it safer. There are a lot of questions for officials on this accident, and particularly as there will be an investigation getting underway to try and identify the causes of what happened in this latest fatal crash.
Bloomberg's aviation and transport reporter Danny Lee. Last look at the markets before the end of the trading day. It was a solid comeback for the North American markets today. The TSX up 1.8%. That's a 563-point gain so far on the day. The S&P 500 up over 1%, and the Nasdaq up 1.4%, or almost 300 points. On the news, Donald Trump says they are halting hits on Iranian energy infrastructure, at least for now. The closing numbers are up when we come back. Stay tuned for that. Here are the closing bells for the end of the trading day. At the Nasdaq, Cooper Companies ringing the closing bell. In New York, Jacobs ringing the bell. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. Markets bouncing back at the start of the week after the American president said they are pausing strikes on Iranian energy sites because there are ongoing talks with Iran on trying to end the conflict. So the TSX had a comeback day of 1.8%, or 566 points on the day. The S&P 500 up over 1%, 74-point move, and the Nasdaq up 1.4% as well. A quick look at oil, which had spiked over the last couple of weeks with what was going on in the Strait of Hormuz. West Texas Intermediate down today $9.50 about to $88.75, so almost a 10% drop on the day. In Canada, mining stocks moved higher, precious metal and mineral prices bouncing back. America's gold and silver up today 9.5%. That's a 70% move, taking the stock price to $8.08. Let's get to G Mining Ventures there. It is up over 8%, or $3.11 to $41.33. Shares of renewable energy firm Boralex moving higher today, gaining 8.6%, or $2.44 a share. That's with reports of companies weighing its options, including a potential deal to go private. according to people familiar with the matter. Let's go to the U.S. market. Some companies also rebounding today. Supermicro was one of them. It's up over 6% after a sell-off last week tied to charges over alleged smuggling of AI chips to China, with the company CEO stepping down in the aftermath. Let's go to Bloomberg's equities reporter Stephanie Hughes for more on the movers of the day. Stephanie, metals moving today. Let's start with Abra Silver, which got a bounce.
Yeah, that's right. So Abra Silver Resources gained by over 12% at its highest point today, marking a V-shaped bounce back from its lows on Friday. So the metals company had its best intraday boost since early February, and that reversed its nearly 15% drop late last week. It's rising alongside other gold and silver names, as you sort of mentioned, after prices reversed their dramatic declines as the Iran conflict was raging. And that came after President Donald Trump postponed military strikes against Iranian energy sources or outlets for 5 days as he described these productive talks to end the war taking place. So spot gold prices were higher until they reversed those gains earlier in the session by over 2% as Iran denied that these discussions were taking place. Silver, for its part, those spot prices also rebounded, erasing losses of over 10%. Also coming into play are falling energy prices and a weaker U.S. dollar. Also helps support precious metals pricing, given that traders were less adamant that the Federal Reserve would tighten its policy just because they don't have to, on bets that they don't have to react to as much as of a oil inflation shock. And a weaker U.S. dollar is also helpful for gold prices since it boosts the demand for non-U.S. countries, just given that it's cheaper metal to own now. So it's not just Abra Silver that's benefiting from this. It's also names like you mentioned, G Mining Venture and America's Gold, Marella.
All right, so the TSX, we saw, got that bounce. But has it made up for that long streak of losses we've seen recently?
Yeah, it's not the complete reversal. It's a modest bounce back for Canadian stocks. TSX looking something like a comeback kid today. On Friday, I was writing about how the conflict in Iran prompted the TSX to lose all of its gains that it made in 2026 when it hit its lowest point in mid-December. So now moving forward to today, that TSX bounced back to its highest since late last week, thanks to the strength in gold assets, miners, producers, and all that. But also it's a matter of names like Shopify and the big Canadian banks adding the most amount of points the TSX gains during today's trading session. So it's not enough to bring it to all-time highs, obviously, but it's a move in the right direction, and it comes down to how this conflict kind of unfolds in the next few weeks and just what ends up supporting the TSX. So it's a move in the right direction. Comeback kid TSX might not be at February highs, Marella.
Okay, we will keep an eye and a watch out of Washington to see what happens next. Stephanie Hughes, thanks for that. Let's get to some movers south of the border. Bloomberg senior equities reporter Bailey Lipschultz is joining us now. Bailey, Palantir moving higher from some news from the Pentagon. Tell me more about that.
Yeah, the stock was rallying alongside other big tech companies, so certainly have to take the move in line with what we saw with broader indexes, but the gains really being driven in part by the fact that their Project Maven was partnered up with the Pentagon for record keeping. Big step forward for the company and kind of plays into the broader bullish thesis, according to analysts, when looking at the opportunity within the government ties to Palantir. Wedbush, Dan Ives basically said it solidifies the long-term partnership with the U.S. military. So again, opening the doors seemingly for a lot of money. And obviously, as it relates to U.S. government contracts, they can be quite lucrative. So a big step forward for Palantir, according to the sell side research. But as you can see, stock rallying today, but still well below where it was earlier this year, even stepping back to where it was peaking out back in late November before we saw really the markets unwind at the tail end of 2025.
Okay, let's talk about Elliott Investment. They're taking a multi-billion-dollar investment in Synopsys. Tell me what shares did as a reaction.
Yeah, stock rallied. Obviously, we do see this as we are in the midst of proxy season, so activist stakes being unveiled and a number of these letters being written or at least published on websites and delivered to company boards. So we did see the stock gain today. As you can see, though, on that 12-month chart, pretty brutal, even from where it was earlier this year, let alone where it was trading late summer before really tanking in September. The big push from Elliott is going to be that they can make more money off of their chip dynamics. So the big question going forward will be, how does that ultimately get executed? But it did seem like, at least today, there was a bit of a bid outperforming the broader market on a day that was quite green.
Okay, I do want to get to travel stocks because they moved higher. They got hit, of course, with the concerns about fueling up, and now with that reversal, they got some strength back. Tell me about that.
Yeah, everything is tied in this market seemingly to what oil is doing. So when we saw the post from Donald Trump and then some of the commentary throughout the day, we did see oil sell off. As you can see, that led to some pretty strong moves for cruise line companies, for airlines, just given the lack of pressure if oil is going to be nowhere near $100 a barrel, if not getting back to where it was in late February. So as you can see, 5% gain for Carnival, more than 6% for Norwegian. United Airlines was the big standout among airline companies here in the U.S., airline operators, up more than 4%. We did see the entire basket trading in the green throughout the day. So that pair trade continuing to play out, where if oil is down, not only are stocks up, but to an extent, these travel companies are going to continue to outperform. So certainly something to keep an eye on as this event, as we continue to track the events and kind of the ongoing updates around the war.
All right, Bailey Lipschultz, thanks for the update. Appreciate that. Coming up, more on the markets and some new investment ideas when we come back. As the markets rally to start the week, my next guest says earnings growth will continue to be a positive driver in coming quarters, and he also has some investment ideas. So let's go to Thomas Martin, Senior Portfolio Manager at Globalt Investments. Thanks for joining us today.
Great. Thanks for having me on your program.
So oil prices wildly swinging all around. Do you see some sort of end to the volatility? We know there's been the announcement by Trump, but that's never a guarantee.
Yeah, the short answer is no, not for a while. I mean, I think that we've been dealing with war, whether it's Ukraine or in the other parts of the Middle East, it's like Gaza, et cetera. But this one, and the market hasn't really reacted to those because really oil hasn't reacted to those. So now we're getting a situation where oil is reacting, and the path to a resolution of that is a lot more complicated, and it's actually really happening. So I think that, going into this weekend, you could see that the markets were starting to incorporate a longer time frame to this volatility, into oil prices, into a resolution. Oil at over 100 was not, 150. It's not 180. And the stock market being down 5% is not the same as being down 15% or more. And yields at,
Okay, we may have lost our guest. Have we lost Thomas? Okay, so we will have to take a quick break. We'll try and reconnect when we come back. Stay tuned. Thomas Martin joins us again. He is Senior Portfolio Manager at Globalt Investments. Thomas, we were talking about oil and earnings growth. You expect growth to accelerate through the year and into next year, but are you discounting impact from the conflict?
Well, if oil prices do stay high, those earnings estimates gains are potentially in question. I mean, the analysts are looking for 16% S&P 500 earnings growth this year and around the same amount next year. So, that's going to be very dependent upon, a normal economy. And I think the market had been hoping that we would get that. It was into the weekend increasingly beginning to discount a longer-term conflict and more higher probability of issues with that. But then with, the tweets this morning, some of that positioning needed to be alleviated. But we really don't see that as an indicator that we're that much closer, although hopefully we are.
One of the sectors we've pushed aside when we've been talking about everything else is AI, right? And how that might benefit some of these companies and benefit their stock price. How are you investing in this theme at this point?
Sure. Well, the AI influence is really a bifurcation. There's the AI enablers, which are clearly the chip companies and the semiconductor capital equipment companies, those that make the things, the data centers, et cetera, the so-called picks and shovels. And you want to be having exposure to those. And those stocks have really outperformed very well this year. The ones that have been getting hit have been software or other things in other industries where it looks like AI might call into question their longer-term growth rates. And so that's more difficult because you have to make a differentiation between those where there really is a significant probability of a permanent decrease in their growth rates, and those where there's not so much, and the companies have the wherewithal to come back from that.
Okay, let's take a look at a couple of stocks you do like. One is Uber, which announced last week it is partnering on autonomous driving or robo-taxis. Is that one of the reasons you like them right now?
Well, it is, and we've liked Uber for a long time, and we have not been a believer that they had an existential threat because of automated vehicles. The thesis is either that, the automated vehicles are going to come in and take over their business, and somebody's going, and what their business is logistics and demand generation and the tremendous connectivity that they have. While that's possible that somebody could take that over, that's a difficult ask. Whereas with their embedded position and their relationships and their cash flows, they can do deals, and they've been proving that over the last several weeks. So our thesis is beginning to come to fruition, and it's a stock that has underperformed of late. So there's some room for that to come back.
All right, definitely one to watch. Let's get to Spotify. Is AI a factor for Spotify growing?
Well, I think that the thesis with why AI could modify Spotify is that, sure, we all like listening to music and we like our favorite artists and we want to put together our playlists, and Spotify does a great job of doing that and segmenting their customers and getting the most out of value that they can out of them by providing a service. But if people start wanting to create their own music using AI and they don't need artists anymore, or they're going to use artists to then create their own versions of that music, does that take away from what Spotify does? It could happen. The world changes, but we don't think that that's really going to be the case or happen very quickly. That part of the reason that people like the music they do is they have a connection with the artists themselves, and that's demonstrated through concerts, et cetera. So we think that Spotify is going to be able to really roll with punches, innovate, continue innovating, and continue to find revenue streams and increase their margins.
Okay, let's get to your last pick right now, which is S&P Global. What do you like there?
Sure. So S&P Global is a company that again, one that took a hit. It's not in software directly, but from the AI threats to their growth rate. Is AI going to be able to take what they, part of what they do, which is the massaging of information and providing that to people and being able to do that, for them, I guess. But the thing is about SPI Global is that they have proprietary information, which they get, through their own hard work, and you can't get with AI. You have to have boots on the ground and et cetera. So we think that most of their business is protected that way, and that, again, the stock has taken an unfair hit relative to what potentially could happen, but which we think is unlikely to happen to that degree.
Okay, Dave, we will have to leave it there. Thomas Martin is Senior Portfolio. He's the manager at Globalt Investment. Appreciate you joining us on the program. Thank you.
Great. Thanks so much.
Conservative leader Pierre Poilievre says Canada has real trade leverage over the U.S. and should use that to their advantage. He spoke more about how he'd handle negotiations with the American president in an interview with Bloomberg's David Gura.
Who's the audience for the speeches that you've been giving on this trip? Is it members of the administration, Americans broadly? Who are you hoping to convey that message to?
The latter. I think first of all, I believe in leverage. We're, as a country, going into renewal of the USMCA, as you call it, CUSMA, as we call it. And one of the greatest leverage points we have as Canadians is the goodwill of Americans. Poll after poll shows Americans like Canadians. They also understand that doing business with us is good for them. So I wanted to accentuate that leverage. I wanted to bring some vivid illustrations of how life could be more affordable for Americans if we had a tariff-free pact between our two countries. And I think when you have Americans on side, the politicians will soon follow.
So your audience is Americans generally, but I imagine you want to convey this to the President of the United States, who's been pushing for tariffs not just with Canada, but countries around the world. Do you think that that message can be resonant with him based on what you know of how he approaches trade?
Yes, because what the president really wants is to repatriate production and jobs to America. And I understand his argument that American jobs have been outsourced to places like China. There are literally cases of American factories closing so that Chinese factories can open. That doesn't happen with Canada. Our role in the American economy is to supply the goods for production. 70% of what we sell you is not for final consumption, but it goes into your production supply chain. So, I'll give you an example. We sell about $100 billion of oil at huge price discounts, by the way. $100 billion, which you turn into $350 billion of final sales. So that means that the refinery worker in Baytown, Texas, is taking heavy crude from Canada and converting it into asphalt and jet fuel and other things like that, earning six-figure jobs. These are like the blue-collar, hardworking American people who the president wants to have bigger paychecks. Well, buying more Canadian goods will allow that. Buying more Canadian lumber will allow your youth to afford homes and your carpenters to swing more hammers. Buying more Canadian aluminum will allow your automakers to produce more F-Series Ford pickup trucks at lower prices to your consumers. So if the president's objective is more American-based production, importing the materials for that production from a reliable neighbor at good prices is part of that plan.
Your itinerary hasn't taken you to Washington. What should we read into that, you not going there on this trip?
Well, I'm very open about it. We only have one prime minister at a time. I don't want to interfere in the negotiations. If at some point the government in Ottawa asks me to intervene and talk with the members of the administration in Washington, I'd be happy to do it. But I think where I can be most helpful is making the pitch to the American people, American legislators and governors, and collaborating with our government back home on making it a success.
I covered the last campaign, and I think there was an inclination on your part to focus inwardly, to focus on Canada, not to take trips abroad. What does this say about perhaps a shift in focus that you have, or a way that you're rethinking your brand of politics?
Well, I think it's addition, not replacement. My calculation is that my support base was basically aspirational, hardworking people who weren't getting what they deserved. Young people who've been busting their back to try and get a home and still couldn't afford one. Single moms who couldn't afford food. Seniors whose rent had just been jacked up. I wanted to speak to them about the problems we had at home. But I think we can continue to do that while adding to the menu strong leadership on fighting for Canada to get tariff-free access to the biggest and most lucrative market in the world, our neighbor next door. So it's not that I'm going to abandon the fight against inflation, the fight for affordable homes and safe streets. It's that I'm going to add to it.
I saw a Canadian pollster write recently, we're seeing a calmer and more reflective Pierre Poilievre. Is this a concerted reset in any way, or is it not that?
I wouldn't say so. Look, I think I'm showing other parts of my persona that have always been there. I don't believe you can fake it. You just have to be yourself. But I want to show people all of the things that I can bring to the job as Prime Minister. And, sometimes in the job you have to be prosecutorial and aggressive, and other times you have to be reflective and strategic. So it's about more broadening the range rather than changing who I am, which I'll never do.
I want to have you draw a contrast between your view of Canada and the world and the Prime Minister's view of Canada and the world vis-a-vis the United States. Mm-hmm. So Prime Minister Carney, went to Davos, delivered this speech, talked about a rupture really an irreparable rupture, that Canada needed to move on because things had changed. Your outlook is markedly different from that. Spell that out for me.
So my outlook is that the United States is and American capitalism is the greatest economic force the world has ever seen. That's not my opinion. That's not an ideological point of view. That's just a mathematical fact. U.S. GDP far outstrips any other competitor. You have the biggest military the world has ever seen, and you're right next door. We sell twice as much to America as to the rest of the world combined. We sell 20 times more to America than we sell to China. Our interests are intertwined with the United States of America. We have to get this relationship back on track, and I believe that we can, because first and foremost, all of our interests on security, affordability, and economic growth are broadly aligned. Our peoples like each other. Our geography, as Kennedy said, our geography made us neighbors, history made us friends, economics made us partners, necessity made us allies. That those whom nature hath joined together, let no man put asunder. I believe that actually captures it. In simple terms, you can't hire a realtor and move your country away, and nor would we want to. I wouldn't want any other neighbor, and frankly, I don't think the Americans would rather have another neighbor than Canada. So let's get past the politics, fix the relationship, and let our countries go forward successfully.
What do you read into the popular response to the rupture comment in specific? It does seem like that resonated with a lot of Canadians who have been frustrated not just by the rhetoric, but with the economic uncertainty and tumult that we've seen over the last year.
Look, I mean, Canadians are a little bit startled and confused about how somehow we ended up in the crosshairs of tariffs and other comments. And so I understand why people feel the way they do. And what I've told my compatriots is, let's focus on what we can control. We can't control what the president says or does. Only he controls that. So what can we control? And back at home, what we can control is unblocking our resources, reducing our tax burden, opening up free enterprise so that we can become strong, self-reliant. And if we're stronger at home, then we will have the unbreakable leverage abroad that will help us get what we want from our American partners, but other countries as well.
The Conservative leader, Pierre Poilievre, with our colleagues from Bloomberg there. Up next, as Desjardins Group completes its acquisition of Guardian Capital, their CEOs join us. That's coming up next. Here are the stories making headlines today. Donald Trump says the U.S. will postpone strikes against Iran's energy infrastructure for 5 days after productive conversations with the country. The American president suggests the U.S. and Iran could jointly control the Strait of Hormuz, which he says could be opened very soon if the negotiations are successful. The head of the International Energy Agency warns the global economy faces a major threat because of that war. He says the situation's severe and no country will be immune. He says the crisis in the Middle East has had a worse impact on oil than the two oil shocks of the 1970s combined, and a worse effect on gas than the Russia-Ukraine war. 2 Air Canada pilots are dead after an Air Canada Express plane collided with a fire truck shortly after landing at New York's LaGuardia Airport last night. The pilots died on impact. Out of the 76 people on board, 41 were taken to hospital, many in serious condition. The accident's under investigation. Boralex shares saw a spike today after a report from Bloomberg that the renewable energy firm is weighing options. According to the report, those options could include a potential deal to go private. Boralex has a market value of about $3 billion and has a number of new projects in development. It builds and operates renewable energy production sites in Canada, the U.S., France, and the U.K. Desjardins Group's affiliate, Desjardins Global Asset Management, has completed its $1.67 billion acquisition of Guardian Capital announced last August. For more on their plans and the current investment environment, let's go to Denis Dubois, President and CEO of Desjardins Group, and George Mavroudis, President and CEO of Guardian Capital. They join us now to talk some more. Denny, let me start with you, if you don't mind. It's a volatile time to do or finish an acquisition. How are you going to approach investing right now?
So I think this is an exciting time for a transaction as we are creating a leading Canadian asset manager with global presence. We've been working on this for a period of time, and bringing the two organizations together will provide increased capacity in order to better service our clients. And so I think this is positive news for Desjardins, but also for Canada today.
Okay, George, let me ask you, what are the key concerns you're hearing from consumers or customers right now, clients right now, given everything that's going on in the Middle East in the last 3 weeks?
Well, geopolitical issues are always of concern in the near term, but I think as investors, we're always focused on the long-term principles, the long-term process that we have, and holding our clients' hands through those short-term crises are very important, so they stay the course. And I think over the long term, basic fundamental economics tend to play out as they should, and just staying invested is an important aspect for investors to always remember.
Is that enough to calm people's nerves when you tell them you got to look at the long picture?
It's increasingly harder, it seems like, because I think newscasts like yourself and others are always tied to the markets on a seemingly by the minute. But our job is really to kind of explain to people on the values of investing over the long term to meet their objectives. And it does take a lot of work to just make sure people stay invested for that long term. It is harder than it probably has in the past, but I think investors that are well educated and are explained clearly the objectives, they tend to do very well by adhering to that kind of advice.
Okay, Denny, the uncertainty now is coming from what's happening in the Middle East, but a lot of your clients are exposed to tariff threats that threw us up and down last year, especially in Quebec, I know. So how are they doing?
Well, I think we do see the slowdown in the economy right now coming out from different sources. The tariff is one. Obviously, we also see the potential impacts coming out from that war. Entrepreneurs are also challenged today just to be able to keep and retain and attract talent. So it's one of the challenge today when we're talking with our members and clients. They do look forward to get a bit more visibility over what's happening in the mid to long term, and hopefully we'll get out of that period not too far in time.
Yeah, with the review of CUSMA, everybody's looking for some clarity there. George, what is your outlook for the Canadian financial sector? And I'm wondering if you do see more consolidation ahead.
Well, we have a very strong financial sector, obviously very large financial banking institutions that are as good as any of those banks on a global scale. I think in the more subsector of the asset management industry, it clearly is a challenge for smaller independent firms to continue to reinvest in an industry that demands a lot of reinvestment and a lot of reinnovation. I think you're going to see continued consolidation in the industry. There's still a lot of succession issues with a lot of independent firms. And I think that's why for us here at Guardian, we feel like it was the right time picking the right partner so that we can continue our journey to build a successful global asset management business.
Denny, when you are looking to acquire, what are some of the parameters? What's the criteria for you to go ahead?
So the first thing is there's really three, at the group level, there's really three sectors that we're looking for acquisition. So we have our two insurance sector, the property and casualty, the life and health insurance sector, and there's wealth management. So that's the first criteria in sectors where we feel we could gain either from scale or from scope. And then the cultural fit is very, very important for us. And this is one thing we've observed with Guardian and George. We've done a transaction together 2 years ago. I had the chance personally to connect with George at that time and learning about the organization, its values, how it's working. And that's a very important criteria for us.
Okay, I do also want to get you on credit loss provisions, because in 2025's results, you reported $688 million for loss provision, and that was up from $597, I guess, the year before, 2024. And the company said the 2025 provision reflects an unfavorable migration in credit quality and a higher volume in loan portfolio. So how are you attacking this? What are you doing there?
Well, the first thing, which is not a bad news in itself, is really the fact that we've been growing our base, or our client base. So obviously that has an influence on the level of the provision. So that's a positive in itself. But I think what we're seeing is the cumulative impacts of different transformation and events that have happened over the years. The pandemic, the high inflation period, now the tariff. You've referred to CUSMA as being creating uncertainty. Now the impacts with oil. So what we're seeing is not necessarily there's one trend, but it's more that cumulative impact that do have and start to affect some of our clients. And obviously, as we see that, we need to get those provisions higher. But one of the things we're doing at Desjardins is make sure because we have a long-term perspective with our clients, make sure we do everything that we can before we get to that place where we need to increase provision.
Okay, I do have to leave it there, gentlemen. I'm out of time with you. Denis Dubois, President and CEO of Desjardins Group. George Mavridis is President and CEO of Guardian Capital and Desjardins Global Asset Management. Appreciate your time. Thank you. Up next, as the war in the Middle East highlights the importance of secure energy supplies, we'll talk about opportunities for this country. Back in a moment. The federal government has a long list of projects it is assessing, and among them a new pipeline in the West. Our next guest says that increasing pipeline capacity in Canada could add more than $30 billion to real GDP every year over the next decade. Let's go to Mark Parsons, Vice President, Chief Economist at ATB Financial. Thanks for joining us today.
Thanks for having me.
How did you get to $30 billion annually? What are you taking into account there?
Yeah, so what we did is we looked at what would happen if we built out 1.5 million barrels per day of additional pipeline capacity. And then what we did is we looked at the pipeline costs. You know, if we did the West Coast pipeline, that's 1 million barrels per day. 500,000 would come from other projects. And more importantly, what does it cost to fill a pipeline of that size, or pipelines of that size? And we estimate about $100 billion of upstream investment. So that's where the biggest kicker is on GDP, is actually like filling the pipeline with new investment. Okay. Then, of course, we get the exports after you build the pipelines.
There are a number of things, of course, that would have to fall into place for this scenario to unfold, and it would have to be on a tight timeline. When, with your scenario, would construction have to begin?
Yeah, so we don't assume anything happens this year. This year, there's a bunch of things that have to happen. There's the April 1st deadline, which is coming up with the MOU on the Pathways project. And then July 1st, the West Coast Pipeline is going to the Major Projects Office. So we expect pipeline construction to start in 2027 and then kind of scale up to 2035 timeframe.
Okay. What would be the cost to the government for infrastructure? And does this scenario involve private partnerships?
Well, I mean, it would include obviously private partnerships. We think the Indigenous communities would, have an equity stake in these projects. Whether there's government money or not is to be determined. We do think the demand for Canadian heavy crude is there in the Asian market. You're seeing that with the Middle East disruptions right now in the Strait of Hormuz. You actually had a light heavy differential narrow. So the demand is there. You just have to make sure that we build the pipeline, within a reasonable time frame and on budget.
Okay, so we're talking strictly about a pipeline right now, but what would be the build out around that?
Build out around the pipeline. So in addition to the pipeline, we do expect, because it goes hand in hand with the West Coast Pipeline, the Pathways project, which would be carbon capture and storage. That would lower emissions intensity per barrel. So that would add additional investment to the economy. Not so much, on the production side. That's more of a carbon capture project. but it is basically a license to build that pipeline and then fill it.
Mark, what are you putting the price of oil at when you're running your scenario? And I'm asking because we've seen such fluctuations over the last couple of weeks. That being said, the price of oil over the last year was depressed. So what are you gauging it at?
Yeah, I mean, we ran this based on oil averaging like $60 to $70 per barrel over the time period of study. So we're not assuming that current prices stay with us. We kind of level out over the time period. I think what's important to understand is this analysis is just kind of a net new impact. So if we're able to get this additional pipeline capacity, we feel like these barrels can come onto the market at around that $60 to $70 price range and be cost competitive.
Talk to me about who needs it. You mentioned Asia. I'm wondering whether you're looking at this solely in the eyes of exporting to Asian nations, or are you looking at other clients or customers as well?
Well, part of the build out on the mainline system with Enbridge is looking into that would be serving the North American market. But we see, of course, the West Coast would primarily serve the Asian market, where those, as I mentioned, those heavy barrels are in demand. And I think what's really important to understand is that Canada has been, for the most part, selling to one customer. What this does, in addition to the economic impacts, is it gives us optionality, meaning we'll get a better price by sending our product to new markets, and also reduces our risk. Right now, we have single customer risk or concentration risk. So we saw that with the Trans Mountain expansion, with the light heavy differential narrowing. We'd see that again with additional pipeline capacity going to Asia.
Where do you see employment for this?
Well, primarily oil and gas industry. I mean, the bulk of it, we'd see it in Alberta because we think the oil sands would be, meeting that additional demand for the most part. But it spreads across the country, right? You have to import equipment. You have to have labor from other provinces. The build out of the pipeline, a lot of that would take place in BC. So it'd be, oil and gas upstream, but also engineering services, transportation services, right through to retail and even housing.
Okay, so I guess the biggest bonuses would go to first Alberta and then BC as far as GDP for them.
That's right. But I think there's an opportunity here because we import a lot of equipment to kind of build out the oil sands. If we're able to get, Canadian steel, aluminum, other products from the rest of the country, especially in the middle of a trade war, I think that's a real opportunity to knock down those interprovincial trade barriers and source more of the material in Canada.
All right, Mark Parsons, so I got to leave it there with you, but appreciate you joining us on this topic. Mark is Vice President, Chief Economist, ATB Financial. Coming up, some hot picks. We zero in on 3 mid-caps. Back in a moment. Time now for hot picks, and we are zeroing today on 3 mid-cap stocks. We're joined by Ryan Modesto, CEO and Portfolio Manager at I2I Capital Management, and we kick things off with his top pick, Badger Infrastructure.
This is a company that has infrastructure in their name, so they're benefiting a bit from that AI infrastructure build out. So the nice thing about this company is most of their fleet, all of their fleet is on wheels, so they can move to wherever the demand is. And this company, they're seeing demand in the U.S. currently, and that's where they've moved a lot of their fleet towards. And about 88% of their revenues come from the U.S. side of things. So they're already levered to good growth on the U.S. They're levered to kind of the infrastructure and AI build-out play in U.S. as well. They've been taking a bit of a hit or seeing some weakness recently on some CapEx spending that the company is doing. Markets don't like that in the short term, but longer term, we think it's good. They're obviously seeing the demand. They're leaning into kind of that demand they're seeing in the U.S., and their return on invested capital is about 11% annually. So any of that kind of additional growth that they're doing, investment that they're doing in capital spending, we think it's a good thing because they're going to capture kind of that 11% return over time.
When it comes to risks, like you mentioned, that capital spending, obviously a lot of investors, we've been seeing that with so many companies who are coming out with this spending. Investors are pulling back a bit, a little bit hesitant about that. Is that one of the biggest risks for a company like this, or what other risks are you watching for Badger Infrastructure?
Yeah, for sure. I mean, a weak economy means you're going to pull back on capital spending plans at the company level. Obviously, a recession, everybody starts to kind of clutch their pennies and their wallets a bit tighter. That wouldn't necessarily be a good thing for Badger. But on the other side of that, the AI investment seems to be kind of bucking that trend regardless of what's going on in the broader economy. So you could have a scenario where you have capital spending pulling back in other areas of the economy, but the AI investment trade still kind of keeps going. And Badger, I mean, not all of their business is exposed to this type of trend, but it should be a tailwind for them as well.
Okay, next up in terms of hot picks, this is an independent power producer out of Alberta, Capital Power. What is it you like about Capital Power?
Yeah, so Capital Power, similar with kind of that tangential exposure to AI happening in the U.S., there's a lot of required demand for energy to power these data centers. You need a lot of energy to power them. So the independent power producers are kind of stepping up to fill in that gap for energy demand that's happening. And Capital Power is doing exactly this. They're stepping up and working on an agreement to help the build out of a data center in Alberta. And they've also recently signed a $3 billion joint venture with Apollo Global to go seek out acquisitions in the U.S. to kind of capture that demand that's happening in the in power demand overall. So that's good. And they've recently had their investor day, and they're targeting annual growth out to 2030 in adjusted funds from operations in the 8 to 10% range, which is a nice growth rate here. In terms of valuation, trading at 20 times forward earnings, which isn't horrible valuation. It's not, maybe not the cheapest, but we don't view it as a very expensive valuation as well, with 4% dividend yield and a lot of transparency and visibility into their future revenue and cash flow profile, which kind of justifies a bit of a premium valuation here as well.
Okay, and lastly, WSP Global. Tell us about this one.
WSP is an engineering services firm. And the big story here is they made an acquisition of a company called TRC in the US, and TRC focuses on the power and energy segment, which, as we were just discussing, has a lot of demand right now because of everything that's going on with that AI infrastructure investment. Mm-hmm. So this acquisition is really just straight out of the playbook for WSP Global, where there's kind of a new growth area, and they go make a big acquisition of a company that kind of gives them like a premier position in that space. And we think they're doing that again with TRC. It's providing a long-term growth platform for them, but also should boost their growth in the short term. Meanwhile, this stock's trading about 18 times forward earnings, which going back to 2017 is a bit of a trough multiple for this company. So we think from a valuation perspective, WSP looks quite interesting.
It's so interesting when we're talking about these mid-cap companies, because obviously what we've been hearing since the beginning of the year in terms of small caps is this is the year for small caps. Do you think, and I know 2026 changes rapidly, there's so many developments every day, but do you think so far this might be the year for mid-caps and it would be a good time to be investing in mid-caps for that reason?
For sure. In fairness, we probably said that last year as well, but if the geopolitics can get out of the way, we think it's a really good setup for the small and mid cap space in general. They tend to be a bit higher growth, tend to be cheaper than large cap peers as well. So we think there's a lot of potential in this space.
And is there anything else you're watching for in terms of like potential rate cuts or rate hikes that could affect mid caps?
No, they will see something. So our kind of view is that rates will sort of slowly come down over time, but we think we're kind of past the rate cut story. We think was more of a 1 year ago, 2 year ago kind of story. Yes, if you get rate cuts, it's going to help things, but we don't think that you need rates to come down to drive the mid-cap space higher. It won't hurt, but we don't think that's kind of the main piece to make it work. It's just kind of fundamental earnings growth, and with a decent GDP economic growth backdrop, we think that these companies will do quite fine.
Okay.
Barring the geopolitical situation getting out of the way.
Ryan Modesto, CEO, Portfolio Manager, I2I Capital Management. Here is how we ended the day on Bay Street and Wall Street. We are in the green on the TSX, up 1.8% today, 566-point move to the positive. The S&P 500 gaining 1.2%. And then the NASDAQ up 299 points, so 1.4% move up on the day. And just a reminder about Know Your Options. It is back Wednesday, 3 p.m. Eastern Time. Have all of your options trading questions answered by Chris Tom of Moat Financial. You can send your questions to Know Your Options at BNNBloomberg.com. bloomberg.ca. Again, Wednesday at 3 p.m. Eastern time for that. That does it for The Close. Thanks for joining us. We'll see you tomorrow.